All right, I recorded for a while, but I wasn't sharing my screen, so I'm starting over. Let's share my screen. And we're going to do exercise 1613. And so what happened is it says we began operations in January of 2018. And we bought a truck, and the cost of the truck is $40,000. Okay, we're going to use straight line depreciation for 4 years. So that means for book purposes, my depreciation would be $10,000 per year. For tax purposes, so tax depreciation, they gave us some rates. So they said that in 2018, depreciation is 50% of the cost. So 2019 depreciation is 30%. 2020 depreciation will be 20%. And that equals 100%. So here, to calculate that out, I would just take it times 40,000. Would be 20,000 here. 12. And 20,000 times 40, or 20% times 40,000 would be 8. So for book purposes, we're taking 10,000 of depreciation each year for a total of 40, and then for over a 4-year period. But for tax purposes, we're going to take 20, 12, and 8, which is 40,000 over a 3-year period. So our numbers are a little different for our book tax differences. So what does it say next? Pre-tax accounting income is 300,000. Ooh. Which includes interest of 40,000 of municipal bonds. All right, that's exciting. So, so basically what municipal bonds are, we call those muni bonds. The interest is never taxable, but it is income on our income statement. So what happens is we call this tax exempt income. You'll learn all about it in the fall. But basically, municipal bonds means you've invested in like the city, state, local government. And so like we could buy bonds in Sedgwick County Parks or Sedgwick County Zoo or whatever. And so some local bond. So local bond income is tax-free. So if you were to invest $100,000 in some bonds and you earned 4% interest, you would get $4,000 of interest income. You do not have to include it on your tax return. You have to list it, but you list it as tax exempt and it is not taxed ever. So it's not just a delay like the timing differences on all the other ones we've seen. It's just something that's never taxable. So what I'm going to do first is I'm going to do the problem ignoring the 40,000 and then I'll bring it in. Okay. So first I'm just going to pretend like I don't know what to do with that and I'm going to solve the problem, which is probably what you did potentially. So let's do our book tax differences. And so we have our financial income and our taxable income. We have stuff, and then we have depreciation expense to get our pre-tax income. Okay, and they gave me pre-tax income of 300,000, and that's accounting income, which is financial income. So I'm ignoring the 40,000 because I'm pretending I don't know what to do with that. My book tax difference on here is financial of 10 and taxable. And am I doing 2018? I guess I should check because I don't know. Yep, 2018. Okay, so 2018 for tax purposes is 20,000 of depreciation. So something minus 10 is 300, so that would be 310. So over here would be 310 minus 20 would give me 290. Okay, so there's my book tax differences, and then I would tax that at whatever the tax rate given is, 40%. So 40% and 40%. So if I'm ignoring the 40,000, I'm going to come back to it, so don't worry. And so this is taxes to get net income / taxable income. Okay, so 300 minus 120 and 290 minus 116. Okay, so doing the journal entry, so let's see what it asks me to do. Prepare the journal entry, record taxes. I will debit income tax expense, skip a line, and I will credit income tax payable. Okay, so this would be 120, this would be 116. My difference of 4,000 would be a deferred tax liability. Okay, so that's what I would do if I didn't know what to do with the muni interest. And so I would have gotten this journal entry, and then this would be the answer for what is the net income. So because I know that the municipal bond is not considered income over here, I would actually need to remove from the 290 the 40,000, because I am not going to have to include it in income. So really what's going to happen here is I'm going to subtract the 40,000. So I can insert a couple rows and do it like right here and just say minus 40 is 250, and then base my taxes on that. So my taxes are going to only be 100,000. But as far as my book tax difference, I'm pausing because I'm trying to figure out, like.
Do you need some help?
No, I'm good, love. Thank you. Okay, so what I would literally do is I'm going to base my taxes so that 310 is right, but I'm not going to pay tax on 40 of it ever. So it's not a deferred, it's just never going to happen. So I don't have to include it in either place because it's not really a book tax difference. And so as far as my tax calculation, I get to subtract 40,000 from here, but it's still income. So when I do this calculation, I'm going to reduce it by the 40,000. And over here, I am also going to reduce it by the 40,000. Because I'm not going to pay tax on it, but my difference is still 4. Good. Okay. But my difference down here is 6. So this is my tax bill. So my tax bill, what I've done is I've removed the 40,000 from both. So for here, I'm just going to delete that number so you don't worry about it. But basically, your tax bill is not based on 290,000. It's only based on 250 because I get to bump the 40,000 off because it's just not taxable. And since it's never taxable, I will also remove it from financial accounting income. So the correct numbers down here, instead of income tax 120, it will be 104 and 100, because this is what I'm actually going to have to pay tax on. Okay, so here, I thought I would pay tax on 300,000. But since 40,000 will never be taxed, I will only use 260. So this number is based on 260,000 at 40%. So my book tax difference is still $4,000, and that's because the only thing that really matters to me here is the depreciation entry, because that's the one that differs between the two alternatives. But when I'm trying to actually compute what I'm actually going to pay, I only have to pay taxes on $250,000 of income because 40,000 of it is never taxed. So it's subtracted from both in my tax calculation only. So What did it ask me to do for the problem? It says prepare the journal entry for taxes, and then what is the net income? And the net income is 196. So it's 196 because it's still income over here. So the 310 includes the 40,000. So the 300 includes the 40,000, less the taxes still includes that $40,000 of municipal income. So don't worry, I don't usually put this on your test. So, but you'll be fine. It's still a good thing to understand is the fact that that money is never taxable. So you will never pay it. So there's no deferred situation because it's never going to be taxable. So, all right, I'll stop my share.